Everyone, while people are still settling down, we'll get started with some brief introductory remarks and housekeeping just to get started. Thank you all for coming out tonight. My name is Cesare Podkul. I'm a reporter on the Wall Street Journal's Financial Investigations team, and I'm president of the New York Financial Writers Association. Oh, thanks. On behalf of our board and our membership, we're very happy to have all of you here, both existing members and guests and others who have come out for this event. So really it brings us great pleasure to host you here tonight. And we're very excited to have Commissioner Jackson with us tonight. And we want to thank you for making the time to spend the evening with us and share your views on a wide variety of subjects. And we also want to thank our executive director, Britt Tunick. Britt, can you please stand up? There she is, yeah. We want to thank Britt for putting on this event, getting this excellent space. And if any of you have questions about membership or becoming a member, she is the person to contact. Before we get started, I just wanted to quickly get a couple of housekeeping items out of the way. For those of you who are new to our events, just want to briefly say a word or two about the association. You may not know this, but the New York Financial Writers Association is the oldest organization devoted to business and financial journalism in the country. We were founded in 1938, and each year we do lots of events just like this one, where you get a chance to network, meet newsmakers, attend book talks, and lots more. If you're into free apps and drinks, this is your place. We also give out scholarships to students who are interested in pursuing careers in business and financial journalism. I'm a former recipient of a scholarship, and I think we have a couple more of you in the room here, so raise your hand, Jeff. Yeah, there we go. So each year we pay out, this year I think it's $25,000 to 5 students, so it's a pretty hefty scholarship. If you haven't applied yet, please do if you're in journalism school. And we hope to increase that in future years as our programming allows. And you can help us with all of this by getting involved. Dues are $60 a year. But if you pay today, you can still catch the early bird pricing, which goes until tax day, April 15th, today, of $50 a year. If you're interested in becoming a member, again, talk to Britt, grab one of the postcards in the back, or just check our Twitter at NYFWA. We just tweeted the link on how to sign up and become a member on there. And you can follow us on Twitter, on Facebook, and our website for additional information about our newest events and happenings. So with that piece of housekeeping out of the way, I'm pleased to introduce Commissioner Jackson and welcome him to tonight's event. Since his appointment to the Securities and Exchange Commission in January 2018, Commissioner Jackson has been an outspoken advocate of bringing greater transparency and oversight to U.S. capital markets. He has been a vocal proponent of the SEC's effort to study the impact of limiting stock trading fees and rebates offered by exchanges, ensuring that exchanges charge fair and reasonable prices for their data feeds, and boosting disclosure on dark pool operators. He has also called on the SEC to review rules governing stock buybacks by company insiders. He did that after doing some research and finding that the percentage of insiders selling shares more than doubled immediately following their company's buyback announcements as many of the stocks popped. And it's that kind of analysis that has earned Rob a reputation for trying to bring rigorous, data-driven, fact-based discussion to our collective dialogue over the nation's securities regulations and the SEC's role overseeing capital markets. It comes from Rob's previous experience in academia at New York University and Columbia Law School, where he headed up Columbia's program on corporate law and policy, and has spent a lot of time thinking about these subjects before being selected by President Trump to join the commission last year. So we're eager to hear your views on a wide variety of subjects today, and we'll structure this basically as a fireside chat, although the fire is out, but let's not, it's probably a good thing on a day like today. I'll ask a few questions to get the conversation started, and then we'll open it up to all of you to jump in with your questions. Commissioner Jackson gets quizzed by second graders whenever he sits in on his mother's second grade classroom and fields many tough questions that are on their mind, probably some a lot tougher than what we're going to ask here. So he's used to tough questions. So start thinking about those now as we get started with a little bit of Q&A. And one last piece of housekeeping, we'll be keeping this conversation on background for now. The commissioner has said he is happy to go on record with anything he says here tonight, but he just asks any press in the room to please contact him before we run a story on his remarks tonight. And we'll also post a video on our website of the remarks tonight, and all of that will be on our website within a couple of days, and will be on record then. So that's a bit of housekeeping out of the way, and with that, we'll just get started with a couple of prepared questions, and then we'll jump right into a discussion from you all, because we're definitely very eager to hear what's on all of your minds. So just to kind of kick things off, very curious, before you became an SEC commissioner, you were, of course, on the outside looking in as a legal scholar, as a professor, an academic. From now the year plus that you've been on the commissioner and having seen the agency from the inside looking out, what is the thing you've learned, or a few things you've learned in terms of that you didn't realize before about how the agency thinks, how it acts, how it reacts to the environment outside?
Well, first of all, thank you for that extremely kind introduction. I'm thrilled to be here.
The microphone a little closer.
Is that okay?
Perfect. Yep.
I'm thrilled to be here. And I was telling some of you earlier during the cocktails that I started my career on Wall Street a long time ago at a firm called Bear Stearns. Not my fault. A great place. I was very lucky to have great mentors there. And I remember in the orientation, they would mention the New York Financial Writers Association, and especially the Follies. And your goal on Wall Street was to stay out of the Follies.
It's true.
So I don't know what to make of the fact that I ended up here. We could talk about that over cocktails. I want to just note that you'll see I'm not long for politics, and the reason is I wanted to have a very candid conversation tonight, which is why I had Cesare give the caveat he did. Matter of fact, a couple of weeks ago, did you see this? CQ did a very nice background on my family. I'm come from a big Irish Catholic family, and they described it. And I could talk more about that if you like. And in the profile, I sat down with the guy, and he said something to me, and I kind of just said to him, "Yeah, I couldn't believe it," and he printed it. Now, normally that wouldn't be that big a problem, except my mother's still upset that I didn't become a priest. So anyway, that's why I like to take a look whenever I talk, make sure I'm not getting in trouble with my mother.
Understood.
So you said, what are the things I've learned since I got to the SEC? So I'll give you three things. The first is the place is full of people who dedicated their whole life to trying to help financial markets work better. And the reason I start with that is if you're in this room, you probably have too. I know a lot of the journalists in this room shine light on the things they do because they believe that those things need to be talked about. And this organization, but everyone in the room, has seen something in our markets that's interesting, or maybe it's troubling, or maybe it's just something that you didn't understand and learned about. And you felt like the Americans that the market's supposed to work for should understand that. And you share a lot with the people who go to work at the SEC every day. And let me just say, there's 4,000 plus staffers. They were there before I got there. They would be there long after I got there. These are the people who really do that work. And they go to work every day trying to do the right thing, number one. Number two, it's an organization built by and designed for lawyers. And it is proof that lawyers should not design the world. Because it's built in a way that is unlike any other building I've ever worked in my life. And like I said, I worked on the street, I worked at Wachtell Lipton for a while. It's built in a way that is designed to minimize the risk that people in it take. And what I mean by that is it's a building that systematically, it's a place that systematically favors inaction over action, that takes as gospel that the fact that we did it this way before is a reason to do it that way again. And all I'll say is that having worked my problem is I went to business school before I went to law school. Like those two points I just made, if you spend any time in business, sound insane, right? It's not the way a business runs. From a business point of view, if someone's already doing it that way, it probably means it's not profitable for you to do it that way, right? From a business point of view, doing nothing can be just as expensive or more expensive than doing something. And one of the things I try to do let me give you one example. Any of you ever come to the headquarters at the SEC? You ever been in the building? Yeah, all right. So the management of the building, the commissioners, where do we sit? Yeah, we sit on the top floor. Now, any other business I've ever worked for, all right, if you work in that business and you run it, you want to be with the people who make decisions. Like at Bear, Ace Greenberg used to work on the trading floor. And he would tell us, the reason I do that is so if I can bump into someone in the bathroom or on the way to coffee or whatever, I can say, hey, what do you see in the market today? What are you learning? Like, that's how you run a place. But we at the SEC, the commissioners sit on the top floor because we're in charge and don't want you to forget it.
It's like that with most government agencies, the top floors.
Yeah, and the problem with that is that if you're like me and you want to know what is going on, it's kind of hard to find out. Because the staff who make the decisions and sit on the floors below you don't come up to the 10th floor that often. Because nothing good happens to them when they do. So another thing to know about the SEC is it's a building built by lawyers over 80 plus years. It's a wonderful place, but it's built in a way that is designed to be reactive. And that can be tricky in our financial markets. Second. And third, whatever you think about what's happening in Washington right now, the SEC, in my opinion, now I'm a biased guy, because I'm working there. But in my opinion, it's working as well right now as it has for years. And the reason is that the chairman I work with, Jay Clayton, who I don't always agree with, but I have great respect for, is taking the job as a way to make sure the government runs as it should. There's just basic things we do with the SEC that have to happen. If you submit a registration statement, you need to get prompt comments. If you are trying to figure out if an exchange wants to make a filing and understand what the rules of the game are going to be for whether we're going to approve it, they need to get a prompt answer. The government needs to set obvious, clear expectations for the market so the market can respond. And I don't speak for Jay, but I think that's a big part of what he brings to the job. And because of that, the trains do run at the SEC. And frankly, that makes me a very fortunate guy in Washington because, like I said, I don't agree with everything the chairman does, but I always get heard. I get a chance to make my pitch. And look, as a former banker, that's all you could ask for. I didn't get every mandate either, but at a minimum, I get to go in and say, here's the things I'm focused on. Here's why we should care about them. And at the moment in the government, I think we can all agree that's not bad. And it's the kind of agency the markets deserve.
So last year, one of the pitches you made and said one of the things we should be focusing on was looking at the rules surrounding corporate stock buybacks. And it kind of goes to that point I mentioned in my introductory remarks about the data-driven mindset that you bring to the job as a former academic and really studying the data and understanding it and crafting rules from that. So I understand you've recently asked your staff to review data on companies' restatement announcements and how they bundle some of those with announcements. Could you tell us more about that analysis and what you found?
Sure, yeah, happy. Maybe I'll talk about both things.
Sure, please.
For those, so one thing I do, basically the way to think about my job is I'm a full-time and here's the way I go about that. So because I was a banker and a corporate lawyer, I remember a lot of the stuff I saw that maybe wouldn't come into the mind of someone in the government because they weren't in the markets. So they don't, you know what I mean? And the people, trust me, the people who come to DC on behalf of the banks, they don't tell you, they give you one side of that story. They don't tell you all the things that really go on in the market. So one thing I do is I just document obvious things that everyone on Wall Street knows. And then I give a speech where I say, hey, this is a thing that's happening. And, I care about it. You should too. Because all I'm doing is pointing to it. So I'll give you an example. My first speech, one of my first speeches when I joined the SEC, when I was a banker, I took a company public. Everybody on Wall Street charged, the fee they charged for taking a company public was exactly 7% of the value of the company. It's a 7% spread. Everyone's known this forever in history on Wall Street. And, if the company was worth less than $1 billion, and all the companies I was doing the dot-com boom of the 90s, so all the companies I were doing were 300, 400, 500 million, you just paid 7%. And I remember going out with my friends on Wall Street in my 20s and being like, this cannot continue. First of all, there's going to be technological change. It's going to get cheaper to bring a company public. But forget about this. It's weird. It's not 7.5%. It's not 6.5%. It doesn't vary by deal. It's 7%. I was like, that's weird. So when I got to the SEC, I had my economist look into it. I was like, hey, man, what's the IPO spread these days? He comes back and he tells me last year in 2017, the IPO spread 97% of the time was exactly 7%. So I gave a speech and I was like, that's weird because you guys are capitalists and this doesn't sound like competitive pricing to me. So they were like, shh. Stop telling people that. So this is how I get myself in trouble. So I gave a speech. Then stock buybacks, that's a big thing right now. So forever, everyone on Wall Street has known for years that the day of a stock buyback, it's very common for the executives at the company to choose that day to sell their stock. I always thought that was a little weird because you're saying two different things at the same time. On the one hand, you're saying, look, the stock is cheap. That's why the shareholders should spend their money buying it. On the other hand, my personal shares, I'm going to sell them. And CEOs don't sell cheap things, expensive things cheaply. So they're sending two different signals about the value of the company. In fact, this has been known since there's a paper about this back in 1992. So when the buybacks issue arose, I just said, look, let's see. We got all these buybacks happening because of the tax cuts. Let's see what's happening with executive selling. And it turns out that executives sell, on average, more than twice as much stock on the day they announce a buyback as any other day during the year. And what they're doing, of course, is they're taking advantage of the fact that the stock price pops after their announcement, and they're capturing the gains. So I got a question from a U.S. senator. And by the way, whenever I do this, I put the data online. I'm like, look, if you want to take a look and come to a different conclusion, 100% take a look. Like, just tell me what you think. And it's a funny thing because everyone calls me up and they're like, you suck. Stop telling people this. I go on Squawk Box and I talk about it and they're like, shh. But I'm like, look, man, the data's online. Just take a look and tell me if I'm wrong. I'm very open to that. And nobody does that. You know what I mean? Like, so it's kind of, do they do that with you?
Well, we like to put our data online too, and we do a massive data analysis. That's certainly the trend in data journalism.
But they never like do their own. I'm like, why don't you run your own thing and call me up and be like, see, I found something different. That would be compelling. Just, you suck. That's not an argument.
Oh, yeah. And then Twitter wars are legendary. And then,
yeah. So then they asked me to rerun the analysis, and I did something else, which I always thought would be interesting, which is when the CEO sells at the time of a buyback, what the CEO is sometimes saying is, look, I don't like the long-run prospects of the company. Not every CEO is saying that when they sell stock. They get stock as compensation. They've got lots of reasons. But a lot of the time, a CEO who's selling shares is saying, I don't love the long-run prospects of the company. If I did, I would hold the stock. So the senator asked us to run this new analysis, and we did. We showed that in the cases where they do a buyback and the CEO sells, 90 days after the buyback, the gains from the buyback disappear. And in fact, the company underperforms. Whereas when a buyback is conducted and the CEO holds the shares, in the long run, the company outperforms. Now, again, you could look at this and say this is totally unremarkable. All it shows is that CEOs know a lot about the future of the company, right? And that's not news to anybody in this room. But I put it out there, and again, I got, you saw, like stop putting data out there. I think this is what's that? Well, so I think there are folks who would rather not have these facts out in the ether. So no one at the SEC says this to me, but the CEOs do, and basically they're lobbyists, right? And again, they do better. They should hire you. Like, get a data guy to take a look. So I did another recent thing I thought you might find interesting, and I wanted to, man, whenever I come to something like this,
of course, yes.
I like to have something new to talk about. So I've been working on this for a couple of weeks. You could tell me. Yeah, I got a chart and everything. Yeah. So one of the interesting things that's happening in corporate America right now is when a company has to disclose that they had a restatement, like a corrective disclosure. Hey, we gave you a number a couple of years ago, it was wrong. A lot of the time, so when they disclose that, the stock price will respond. And in the last 10 or 15 years, it's become very clear that the stock's drop, to the degree there is one, will be the measure of damages in the lawsuit that follows. Does that make sense? So like, if there's a stock drop, the lawyer's gonna say, well, the restatement caused that drop. So those are my damages. So this hasn't been true for that long. So what companies have started to do is bundle good news and bad news together. And you all know this because I'm sure you've had sources over the years who came to tell you something really bad, but like wrapped it in some good news. Like they're trying to be like, yeah, I think I'm getting fired, but I'm gonna get time with my family. Like. So what we did a study where we basically looked to see how often, when a company announces a restatement in corporate America, how often do they wrap it in good news, like the fact that they have new earnings and they beat expectations. In the year 2000, the answer was less than 5% of the time. Last year in 2017, they did it 20% of the time. And it's just a straight increase. They wrap bad news in good. And the reason they do it is they think if I wrap bad news in good, the stock won't fall and the damages will be zero. And one of the things I'm pushing for and calling for in the SEC is not to let corporate managers do this. Because what I want is a clean signal from the market. Look, things go wrong in companies, but when you disclose it, the market will tell you what damage was caused. And we shouldn't let corporate managers control that, right? Those things should have to be disclosed separately so you get a clean signal from the market about what damages have been caused. And if we did that, if we forced companies, when they have a restatement, to come out and say it clean, rather than wrap it in good news, I think we'd have a much better functioning market.
Yeah, we can't do that in the news business. Our editor would tell us, you're burying the lead. You got to always lead with the most important. You can't bundle, too much stuff in the lead paragraph. But so this is pretty fascinating. What are you proposing the SEC should do about this?
So we should have a rule, in my opinion, and I'm open to all kinds of in the details, but we should have a rule that says you can't stuff bad news in good wrapping. If you have a restatement you need to make, you got to come out with a clean disclosure that provides that bad news to the market to see what it's worth. If you want later to add some good news, okay, but first come out with these things separately so we get a clean signal from the market as to what the damages really are. Look, another approach, if you really want to go further, is not to use the stock price reaction as the measure of damages. Does that make sense? Because then executives wouldn't have this reason to bundle this all together. But I'll tell you, that idea is not going to be too popular with my colleagues. They really like the idea of using this measure. I got feelings about that. But the short version is, if you, look, this is what bothers me about this. If you tell corporate managers we're going to measure the damages by the stock price drop, then they're going to do things to prevent the stock price from dropping. I'm not mad at them. They're just doing what the incentives are under the law that we have. That's why we have to change the law, to give them incentives to tell the market the news cleanly so that we can actually respond to what's happened.
And on that point, while we're talking about corporate disclosures, are you a fan of not requiring companies to report quarterly, but maybe making them report just every half year, so that managers can focus more on the long run as opposed to the short-term thinking, as the theory goes?
Oh, long-termism, short-termism. What do you guys think of this? You guys don't get to see this. It's very funny, but someone in the back just literally went. So, first of all, did you guys see the president himself tweeted on the subject?
Yes.
He met with the CEO of Pepsi, whom I know. She's an extraordinary leader, actually. He met with her, and she mentioned it. And so he tweeted, this short-termism quarterly thing might be a real problem. SEC needs to look into it. And, of course, it was a funny thing, because for the next 3 days, my phone was blowing. People are like, he tweeted about the SEC. It's unbelievable, the news that this guy creates. It's incredible. Yeah. Now, the good news is the SEC had been looking into this subject for a long time. And we've been studying for a long time whether we should change the frequency of reporting. Here's my 2 cents. Sure. I think, in general, if you're going to convince me that quarterly reporting is leading to a problem like this, you have to convince me there's a market failure. In other words, you have to convince me that giving people information causes them to make bad decisions. And that is not my intuition. Right? My intuition is you give people information to make better decisions. And that, that's not me. That's like Brandeis. But I will say the following. One thing has happened that we should all think about, and people in this room, because this organization has great history, should think about it. Remember that earnings quarterly, forgetting about the 10Q and quarterly reporting, I don't think that's actually the important, where the action is here. I think where the action is in the quarterly earnings guidance and the earnings call that happens. Remember, guys, this is not always how this worked, right? It wasn't always that the CEO guided to it multiple times a quarter, and then you had the call, and you kind of tried to get a sense on the call, how confident does this guy feel, and does he really feel like he's doing well? It wasn't always like that. This practice grew up over time, partly because investors wanted it. They wanted to know, are you going to hit this bogey that you've set? But we haven't looked at that at the SEC in a long time. Also remember, the analyst settlements from 2003 are now 15 years old. We haven't looked for a long time at how well that's working, whether analysts still have conflicts, what kind of feedback they give at the earnings call, how much earnings pressure there is. I'm open to looking at that. I will say something does disappoint me in the journalistic coverage of this. So in my office, the thing we talked about the day the president tweeted about it was the incredible irony of describing a problem of short-termism on Twitter. And nobody wrote about that. Come on, man.
I'm a long-term focused journalist, so I'm very sorry. My stories take months. But speaking of bringing information to people so they can make better decisions, the SEC is doing an exercise like that of its own. It's called the Transaction Fee Pilot, which for any of you in the room who aren't familiar with it, it's a huge first-of-its-kind data gathering and analysis exercise that the SEC plans to use to gauge the impact of fees and rebates that stock exchanges impose on brokers for taking and making liquidity available on their venues. Now, this has been the subject of much debate from both sides of the issue, and it often turns into a he said, she said discussion over whether rebates and fees are good for investors or not. Putting your data hat on, what do you think is the objective truth of this rebate maker-taker system as it stands today? Do you think it opens investors to conflicts of interest with brokers and exchanges that may cost them when it comes to best execution, or do you think it benefits them through tighter spreads and better execution?
So I thought maybe we'd give a little background
Sure.
for those who haven't.
Definitely. This is one of those issues that needs background for sure.
Yeah, man. It took me like 6 months to understand. So,
Same here.
yeah. So the way this basically works is the major exchanges make payments or charge fees to investors who bring trading to them. And the degree to which this has been a subject of study for a long time, there's an argument that this causes a conflict. The conflict it causes is that the person who's doing the stock trading is going to bring the transaction to the place where they get paid the most, instead of the place where the investor is going to get the best price. And that's going to be true, except to the degree the law forces them to get the best price. And we have a rule about this. It's best execution or the order of protection. These rules are meant to work together to ensure investors get the best price. The problem is that they're not very binding. So there's a lot of room within best price. There's a lot of room to make those judgments, and the fear is that there's this conflict of interest. Now, the question Cesare asked me is, what's the truth of this? Is this really good or bad? And the truthful answer is, I don't know. I have no idea, which is why we're doing the transaction fee pilot. Because the question really is, are those payments necessary to create the kind of liquidity that we need to run a good stock market? The exchanges have argued that they are necessary. Others have argued powerfully, I think, that they're not necessary. We're going to test it. And remember I said earlier that because the chairman is so focused on running the place that the trains are running on time, this is something we should have done a long time ago. And we didn't because it is hard. It's hard for the SEC to come out and say, hey, we don't know whether this is good or bad for investors. We're gonna get some data and find out. That's a hard thing for a chairman to say. But it was the right thing for him to say, and he did.
Yeah.
And I'll say something else. He brought in a guy, Brett Redfern, who's the director of the Division of Trading and Markets, who gave up a lot here in New York to come down to Washington and run this. And he's trying very hard to get this right. And sometimes he goes further than I'd like. Sometimes he doesn't go as far as I'd like. We don't agree every night. But at the end of the day, he is trying to get to the truth of what kinds of transaction fees, what kind of payments do you need to create the liquidity we want? And once he understands that truth, he can come up with a rule that makes more sense for investors. So I really admire them. And I've been very supportive of this. I came out aggressively in favor of it. And the reason I did that is Jay and Brett are trying to do the right thing, and I want to support that. Let me say one more thing about that. There's one move in this debate that really makes me mad, because I just think it's wrong. The argument is to say, this is a debate. This is a food fight among very wealthy people. It's the exchanges on the one side who are doing great. It's the banks on the other side who are doing great. Who cares? I do. And here's why. Everyone in this room knows that those fees that get charged, they get taken bit by bit from investors. Because if you spent 15 minutes on Wall Street, you know if they charge a fee, whoever's paying that fee, it's not them. You know that. That's getting passed on to an investor. And my problem is, I'm a kid who wasn't supposed to have a job like this or go to law school. And the reason I did is because my parents put money away. And I can see that the system we have today is meant to take bit by bit. You don't notice it, but little by little. And then you look up and it's 20 years later and you want to send your kid to college or you want to retire. And that number's not as big as it should be. And for me, that's why I care. This is not a food fight among rich kids. This is a fundamental question over, do we have a system that's fair to the Americans the markets are supposed to work for? And I think Brett and Jay are doing the right thing, and that's why I support it.
Now, on March 28th, the SEC unexpectedly halted part of the transaction fee pilot as the U.S. Court of Appeals for the District of Columbia is considering legal challenges to the proposal. The big exchanges, NYSE, NASDAQ, and CBOE have sued. They're trying to obviously stop the pilot from going forward. And I guess there's two ways to look at it. Either this is a big win for the exchanges, or it's a savvy move by the agency to basically go ahead with the least controversial part of the pilot, the data gathering while the courts decide on the more controversial aspects of it. What are your thoughts on the SEC's move to lit?
This is the part of my job that I hate because it's ongoing litigation, so I really can't say much about it. I'm just going to say...
Still got to ask.
Yeah, no, ask for sure. I'm happy to be asked. I just wish I could say more. I legitimately, seriously wish I could say more. It's ongoing litigation. I think I understand. Look, the key to me is to do it. And I can't tell you, there are powerful forces who would like to wait us out. Like I said, we have a few key people in good spots right now who are trying to do the right thing. And my concern would be delay. Because I don't think it's healthy for people to say, you know what, we don't really like the policy you came up with, so we're going to hire a law firm to hold you up for the next 2 years, and we hope we get someone else who does something we like better. I don't think that's a good way for the railroad to run. As you pointed out, a very important point here is that we're still going to be able to collect the data.
Right.
So we haven't actually slowed down the process and in a way that worries me yet. And I'll leave the rest to the courts and to our general counsel to work through. But fundamentally, for me, my view on the transaction fee pilot is we should have done this a long time ago. It's time to test these payments and how they really work, these fees and how they really work. And I'm going to be a guy who pushes very hard that happens soon.
One more question, and we'll open it up to the Q&A from the audience. You mentioned that there's this, some people are saying that this is just an argument between rich people on Wall Street about who should make more money. And that's almost exactly the same thing I heard when I went to the SEC in October for the roundtable on data feeds. I forget who it was, but one of the roundtables, someone mentioned that this is not about apple pie and hot dogs. This is about BMWs versus whatever car make was. I think it was a Maserati or whatever. But that was in context of data feeds, which are another hugely controversial issue. The cost of connecting to data and acquiring data from the exchanges just keeps going up and up and up. IEX has publicly disclosed its cost to provide market data and connectivity. I'm just wondering, do you think other exchanges should do the same?
So again, without commenting too specifically on things that might come before me, we have said some things that are still subject to litigation about data, so I don't want to say too much about data. Here's what I will say. Like I said, I started my career on Wall Street. When someone tells you, don't worry, this is not about you, I'm fighting with somebody else over here, usually they're taken from you. And what they prefer you do is focus on this other thing over here, like Mercedes and BMWs, right? So to me, what frustrates me about this argument is that it's not engaging with the facts. Like, if you want to say we are doing the right thing for investors, say that. This is the right system. We believe it and defend it. Instead of turning it into a political game about these are two sets of rich people fighting, so don't pay any attention. Look, here's my problem. Right now in our country, we have a moment where there are a lot of people who feel like what we do in finance does not work for them. It's a game that's rigged against them. It's not meant to include them. And it is driving an enormous, even in my own family, it is driving an enormous divide between people who feel like they're part of that club and people who aren't. And to me, there's no more hurtful argument to the progress of debate in this country than to say, don't worry about it, this is just rich people fighting. Like, I don't understand, that's not an argument about whether or not we are doing the right thing for you, whether we have created a system that works for you, whether you have the market you deserve as the American public. So to me, that's not an argument. That's a claim that's like a political smokescreen. It's not a serious argument about the degree to which investors deserve the markets or getting the markets they deserve. Bless you.
And with that, questions from the audience. Myron, please introduce yourself, who you are.
I'm Myron Kandel, formerly of CNN. I have a question. Cesare mentioned that you were appointed by President Trump. What he didn't say is that he had to appoint a Democrat because the commission is usually 2 people in the minority party and 3 in the White House party, right? If President Trump was sitting here tonight, he would disagree with everything you said, okay? We know very well from what we read and hear about his influence or his unhappiness with the Federal Reserve, which all of us journalists know was previously considered untouchable by politics. So my question to you is, are you feeling the influence of President Trump on the work of the SEC?
So we're starting with an easy one. So, Myron, I remember sitting in an audience like this, watching a guy like in a job like mine talk, and I saying to myself, I wish they just give a straight answer. So you asked a straightforward question: am I feeling the pressure of a particular White House view? And there's a yes or no answer to that question. The answer is no. And I understand from the outside looking in why you might think that. I'm here to tell you that that does not influence my day-to-day work. I'm not saying it never will. I'm saying I am very fortunate to work in a building where the independence of the regulators is taken very seriously, and to work for a chairman who has a deep reservoir of respect on both sides. And I won't speculate, but also I believe at the White House, so that we are permitted to make the decisions that we think are best for the market. Now, if you're wondering more generally about this president's view about financial regulators' independence, et cetera, I'm happy to talk about that. But you asked about my experience, whether or not I have felt that influence. And the answer to that, Myron, is no.
Is this on? Yeah, I guess it is. Gail Silberman, I'm retired. But when you talked about separating signals, good news not being wrapped in bad news, et cetera, have you had the argument? And if so, what do you say to somebody says, you're infringing upon my First Amendment right to say what I want?
Yeah, I get that a lot. Yeah. So it's a great question. Her question basically is, look, doesn't the First Amendment permit companies to speak as they wish? And my answer to that is no. In 1934, in response to the Great Depression, we made a decision that fraudulent speech was going to be limited and prohibited by federal financial regulators. We can debate whether that was the right bargain to strike or not. I think over the last 85 years, it has served American investors and companies well. But I'll put it to you this way. If the First Amendment stops me from prohibiting companies from committing fraud against the American public, 9 guys in robes are going to have to tell me that. And I don't think they will. I don't think they will. Because fundamentally, if you look at the history of the First Amendment's jurisprudence, the court is very careful to judge, to make sure we abide the limits of regulating commercial speech. But it's been very clear for a very long time that the 34 Act, the 40 Act, I mean, all the statutes that empower the SEC to act arguably infringe the freedom of speech. Look, fundamentally, getting someone to come out and say that they did something wrong when they'd rather not infringes their freedom of speech. But I'm okay with that. And in fact, I don't think a very thoughtful conception of speech includes that. In other words, I think of what everyone in this room does as crucial speech, central to the bargain of the Constitution. I think of political speech as infringement of this, I think the courts would not abide, and they're right. Journalism, same thing. But fraudulent speech, telling you something that's not true, this has never been entitled to the kind of profound protection that I think we have in mind. And so when people make this argument, I want to be respectful of the First Amendment. I think it's important that the SEC not cross those boundaries, but I'm very comfortable that rules forcing companies to cleanly say we have bad news rather than bundling it with good would be within those bounds. You guys are tough. So it's funny. He mentioned this. I said in a speech once that my mother teaches the 2nd grade. As a matter of fact, she's 31st year. She's retiring in 3 months. Yeah, it's crazy. What a story. And every year I go and I sit on the magic carpet. And the rule on the magic carpet is you can say you just have to tell the truth. That's the rule on the magic carpet. My guess is all of you would love to have we should get a magic carpet. Yeah. Yeah. So it's funny. Over the years, I go up and I get questions from the 2nd graders. And over the years, I get the two questions I get every year that are so hard are you married? And why not? And I figured it out over time. I think my mom was planting those questions. So if I can survive that, I'm happy to answer any questions you guys have.
Hi, William Friedman, freelance. I write mostly for Global Finance Magazine and HFM. You said that you were involved in bringing public a lot of IPOs during the dot-com boom, and now it seems like we have an echo of that with the digital asset boom, the ICOs and the cryptocurrencies and such. I appreciate your sense of what's different this time, what's the same this time, and what the SEC's response is and what it might be if you could wave a magic wand.
Yeah, what a great question. So he's saying you lived through the 90s dot-com boom. Now you're seeing, from a different perspective, the ICO market. What's similar, what's different? So a few things. So first of all, one of the things the SEC, I got to say, like, just spoiler alert, I'm very proud of the stuff the chairman and our enforcement guys have done on the ICO front. Say what you want, man, they have been aggressive. Like, they came out even before I joined the commission and said, we think many of these fit the definition of a security. There were lawyers out there saying this is not even a security. You don't have to obey the securities laws. They don't even apply. And the SEC came out, I thought, really clearly and said we're not sure that's right. We're flagging this for you that if you have a security, you have to follow the law. They've done good work on it. I'll give you an example. One of my favorite things that I remember from when I was on the street, and one of my favorite things since I've been at the SEC. During the 90s dot-com boom, I don't know if there's no reason to remember this. The SEC at the time, which was led by Arthur Levitt, brilliant chairman, was concerned that people were not reading the prospectus. They weren't reading the IPO documents. They weren't looking at it carefully. So the SEC at the time did a fake IPO. Like, put up a registration statement that was about a fake company. And, like, people were calling up being like, hey, how do I invest? It sounds great. And what the SEC did was they used it as an education. They said, here are the signs that this was not real. There's no earning, there's no intellectual property, there's no idea. It just says .com. It doesn't have anything to do with the internet. Like, that's not a thing. I'm very proud of this. This wasn't the staff are unbelievable. They did, like, 3 months into my time at the SEC, they did a fake ICO, a fake initial coin offering. Now, there's no reason for you to know this, but there's a little legal detail here that the definition of a security or secure investment contract is defined by the Supreme Court case called Howey. And if you're a securities, no offense, but if you're a securities nerd, right? I mean, come on, I feel like that. They know, man. Yeah. So we named it Howey Coin. And we did a fake ICO. And I'm telling you, man, if you Google this, look on Reddit, there's people like, hey, this is a great idea. And then they're like, wait, maybe it's fake. And the picture of, like, we had a white paper describing the idea. And the picture is like the guy, the SEC staffer who ran it. So they looked at his picture and then they compared it to LinkedIn, and they're like, the LinkedIn thing is like his SEC page. It was like, I think it's the same guy. So first of all, there are a lot of similarities. I will say one difference is I remember raising money in that environment, and it was easier than it should have been. People weren't diligencing everything the way they should. But today, with the internet and social media, it's a different world, man. I mean, look, without judging any particular matter and being my lawyers would be upset. There's, I think, a guy who did something called fake coin. I mean, it was right there in the name. And I think he raised like 50 million. I mean, it's unbelievable. I feel like right now it's a moment where people, and this is what I was trying to say before, not that artfully, people feel like there's another game out there that they're not in. Does that make sense? And I feel like that's a big part of what tempts people to get in this kind of thing. I'm missing out because I don't have the right friend, or I don't know the right thing, or I didn't go to the right school. But here, I can get in on it, so I'm going to try. And there's a level at which it's hard to blame them. I understand what that feels like. I understand that. Our job at the SEC is to educate them and make clear that, if there's an offer that would give you twice as many securities if you buy them in the next 15 minutes, be skeptical of that. Like, that's not how Wall Street works. So I think we've done a pretty good job on it. I think there are a lot of echoes in the two eras. But one thing I'm really proud of is I think we've stepped out up and gotten ahead of this. I think we have a lot more work to do, but I think we're doing okay so far. Oh shit! How much time you got? Yeah. So there are a number of sort of there's a lot of background on this. I personally, to me, the most help. We just put out some guidance on this a week or two ago. The most helpful thing, I think, our director of corporation finance, Bill Hinman, gave a speech about a year and a half ago that describes this. You might know the speech I have in mind. Let me just quickly summarize the intellectual problem and tell me if you disagree. The intellectual problem is, to the degree that you sell a token that is meant to let somebody use existing infrastructure, many times in our past we have assumed or concluded that that's not a security. Let me give an example. Airline miles. Right? Airline miles, you get them. They can be sold sometimes, right? Like there's a way to sell them or transfer them. There's limits on that, but you can hold them with the expectation that they'll go up or down in value. But because you're using them on an existing infrastructure, which is the existing airline that you work on, and there's rules of that game, we typically tend not to think of that as a security. On the one extreme. On the other extreme, you have a situation where someone sells a token for infrastructure that doesn't even exist yet. Does that make sense? And says, give me this money so I can build this thing, and then you can use a token to use that thing. It's a different case. Why? Because, look, man, I'm not against you selling a thing to raise money to build something. I just got a name for that. That's a security. Like it has been thought to be a security in many cases, not in every case, but in many cases for a long time. That's it. So the question is, where do we draw that line? And the how we test and the guidance we put out in this area has informed that difference. Now, one more thing. You mentioned cryptocurrency. What's important about that is to realize that the way that cryptocurrency works when it is, and this is what Bill Hinman's speech says, so I'm not adding too much, depends fundamentally on how centralized or decentralized the underlying network is that that supports that currency. And that's also true in the ICO context. Bill has said a lot about that, about ways that practitioners can look in that area and get a sense for whether or not we should think of that as a security. And I point people to that speech. Do you think we've been clear enough about that? No. Yeah. Yeah, I expected you to say that. Now let me ask you this. No, seriously. I've heard that a lot. What could we do that would be more clear? Mm-hmm. So let me just, I want to be clear because a lot of people have come in and asked us for more guidance on this, and it's not that we don't want to be. I don't speak for my colleagues. Not that I don't want to be responsive. It's that I worry that if we make a rule today, it will make a lot less sense to the marketplace in 6 months in this space. Do you see what I'm worried about? And for better or for worse, the machinery of the bureaucracy of the U.S. government works in a fashion where if I were to pitch a rule and know exactly what it was, exactly if you and I could get a beer and agree what the rule should be, by the time it became law, it'd be a year later. And by that time, the ground will have moved underneath us. So if you sense, at least from my point of view, wanting to give this some time to figure out and do it by guidance as opposed to rule, that's what's driving us. Now, you might say, Jackson, that's the problem. Why don't you move more quickly? And from your lips to God's ears, man.
Hey, Commissioner. Ian Wennick from CityWire. So you've been a pretty persistent critic of the economic analysis underlying regulation best interest, the broker conduct package. Does it concern you to see states get so frustrated with the pace of rulemaking that they've started introducing their own rules? Nevada had regulation up the books, and now New Jersey just unveiled a whole proposal today.
So I'm sorry, what was your name? So Ian's question is, we're working on this. Do you guys know the regulation best interest backdrop? You familiar with this? The basic question is, what obligations does a broker owe you when they sell you financial advisory services. And the problem is that it's grown up over time in a way that investment advisors have one standard under the 1940 Investment Company Act, and broker-dealers have a different standard under the 34 Act. And the question is, what should the standard be? And we proposed a rule last year that called Regulation Best Interest that attempts to raise the bar for broker-dealers for what obligations they owe you when they advise you, and also clarifies the standard for investment advice. I think your question is, I have been critical of the economic analysis there. And I think your question fundamentally is, to what degree do I expect, how do I expect this rule to unfold, and what do I think the economic advice will look like? So here's my thing about this. Suppose I were to say to you all, we are going to raise the standard so that when a broker talks to a client, they have to be clearer about what they're selling and what it costs. Is that going to affect those people's behavior, both the broker and the client? What's your reaction? See, it's funny you should say that. So I'm going to say about half of you shook your head because you're cynics. Fair enough. And said it won't change anything. People won't understand and the brokers will dance their way around it because that's what brokers do. Right? Is that a fair summary? Okay. The other half of you said, well, actually, maybe it would, because a lot of brokers want to do the right thing. They're going to ask people what the rules of this are, and they're going to say they're only going to make a pitch that they're allowed to make. It is what a guy like me likes to say, an empirical question. This science can answer this question, right? What you should do, I think, is test it. Take a bunch of brokers, tell them this is the law, and tell another bunch that this is the law, and see how they respond. Talk to a bunch of customers. Say, here's the disclosure. Give another group a different disclosure. Choose them randomly if you want to get close to the level of science required, for example, by a medical trial, and see what the effects are. That is what I have said we should be trying to do with Regulation Best Interest. Not necessarily. Look, everyone who comes into my office swears they know the answer to this question. They say this won't do anything, or it's too strong, or it's too weak. And the more they yell, the more I know. You don't know. You don't know. And by the way, what makes you think it's going to be the same for people in New York as it's going to be for people in Florida, as in Nevada? And I'm making one rule for the entire nation. How am I supposed to be confident about the way those people will respond? And that gets to the question you really wanted to ask me, sir. He said, how do you feel about the fact that states are moving forward with their own rules, in part because they're impatient about the SEC? Now, I'm not sure I grant the premise that their impatience with us is what's driving their action. I think what's driving their action is they think they need to take steps to protect investors. And my view has always been that the state should do whatever, I mean, that's what we have a federal system. States should do whatever they think necessary to protect their investors. Do I think if we came out with a strong regulation best interest that everyone in the marketplace was convinced was good enough, do I think states might defer to us? They might. But that's on us to come out with a regulation best interest that people think is really going to protect people. And my goal is to come back to you in a year with a rule that's so strong that even a room of skeptics like this could agree that we did a good job. So wish me luck.
Hi, my name is Natalia. I'm a graduate journalism student at New York University, Forbes contributor, and CNN business intern. My question is about collateralized loan obligations. The market for CLO is expanded over the past few years. So my question is, from your point of view, is there anything that should be done in terms of ratings for CLO?
Ratings
Great.
for CLOs. Okay, so I'll take the last question first. Oh, I always forget to do this. You didn't remind me. So my lawyers are going to be it's on tape. So these are only my views. It's not the other commissioner's views or the chairman's views or my mother's views. They're only my views. It pisses me off that they make me say this because everything I've ever said in my life is just my view. Like, what does that even mean? And of course, I'm going to try and convince them. So whenever the lawyers make me give this caveat, these you can tell what kind of guy I am to work with. This is the problem with hiring a kid from the Bronx. So they say I have to say these are only my views, not the views of the other commissioner. I say, given enough time and wisdom, they're going to realize I was right all along. So CLOs. First of all, am I concerned about the leverage implicit in the CLO market in that lending standards have gotten loose? Yes. Yes. And in particular, I think, in fact, my experience, when I talk to people on the street about it, I think that asset class actually did experience a little bit of a pause, a breather about a year ago. And that was, I think, a very healthy market response to people feeling like they didn't fully understand what was in the box and understand the ratings. Now, you asked a question about ratings that I think I need to address very clearly. One of the biggest challenges in the work of the SEC right now is how little competition we have in crucial areas of our markets. How many rating agencies are there? How many rating agencies? You know, bid 2.5, ask 5. What it's in between, right? It's surprising to me that a market as deep as ours doesn't have more competition in that space. Stock exchanges. How many do we have? We've got 13 lit stock exchanges, public stock exchanges. 12 of them are owned by 3 conglomerates. Only 1 actually independent stock exchange. My answer to you, does it concern me what's happening? Here's what does concern me. In an industry where there's only 2.5 competitors, 3 competitors, I'm not sure there's enough competition to get investors what they deserve, which is an accurate rating. Now, we have an Office of Credit Rating Agency, credit ratings, created by Dodd-Frank. These people are tremendous. They do great work. What they do is examine the credit rating. They go in, they ask them questions, they ask all the hard things that people felt should have been asked in 06 and 07. And they do great work. But fundamentally, do I think questions from Washington will do as good a job as competition in disciplining these guys and making them give the right ratings? No. No, I think competition would do a better job. And we don't have any. And fundamentally, the question we needed to ask, which is how do we go from a world with 3 credit rating agencies to a world with 10, we didn't answer. We didn't answer. I gave a speech about this a little while ago. It's a funny thing, because you think back to the creation of the SEC, back to the Depression. People don't know this. The SEC was created in 1934, but the Securities Act that nerds like us think about a lot. The Securities Act was passed the year before in 1933. So the regulation of securities had to go somewhere else. Do you know where it went? Which agency ran securities regulation in this country before mine existed? The Federal Trade Commission, the antitrust enforcement. In fact, if you look at the enabling statute of the SEC, we are supposed to consider, among all the things that we regulate, competition as among our priorities. But you don't ever hear us talk about the ways that the choices we made led to having fewer bulge bracket investment banks. When I went shopping for a job 15, 20 years ago, there were a dozen, not anymore. 2.5 credit rating agencies, 3 conglomerates that run most of our stock exchanges. So my answer to you is, what concerns me about this? What concerns me about ratings in CLOs, but more generally, is that we don't have 10 people fighting like hell to get it right. Because if we did, I'd be more confident. Instead, we rely on the system we have, which is just 2, 3, 4 credit rating agencies overseen by Washington. And the people there do great work, but they're not perfect. They're people. And I do worry that we might wonder about whether they got the ratings right a few years from now. Sure. So here's what I'd say about that. I'm a guy who worries a lot about conflicts, but conflicts are all around us in the world, right? After this, I'm going to dinner with my fiance, assuming she's still dating me. Yeah, it's such an embarrassing mistake. I'm a corporate lawyer. I left too much time between signing and closing. I got engaged like 1.5 years ago, and I'm giving her a lot of time to think this thing over. It's bad. I'm going to dinner with her. I'm going to ask the waiter to recommend a bottle of wine. All right? Now, the guy gets 20% of what he sells. So is it going to be astonishing to me when he thinks the best bottle of wine is one of the most expensive? It is not. But I understand that's the deal, and if I ask him for a recommendation, that's where this is headed. Issuer pays is a basic conflict. There's conflicts all over. And I actually, here's my problem. I don't want to be the guy who criticizes every possible way to do something. I'm not saying issuer pays is the right model. I'm saying someone's got to pay, right? So let's figure out who that is and make sure every American investor understands that conflict's in our market. They go to buy a car. They go to dinner. They live in the economy. They know that fundamentally people can be conflicted. That's not fatal to the system. What's fatal is telling people that they're not conflicted, that you're their friend, that you're going to help them, that you have their interests at heart, when in fact you're trying to get paid. That's when people, in my experience, actually feel defrauded.
Hi, my name is John Knuckle. I'm a financial advisor and a freelance writer. I'm also a fiduciary. So the question is about the fiduciary rule and the push to lower commissions and the increased technology. Within my colleagues, we all look at it as something that's going to kill the small investor. And the reason is fiduciary structured as gets paid for assets under management, a percentage of assets under management. Now the standard's about 1%. Technology is making it 3/4 of 1%, a half of 1%, which means that if a client has $500,000, you can make $2,500 all year. What is happening is, and it's happened with my own firm, is they're in a very compliant way saying, we don't want clients with less than $500,000. Now these people are going to be, and it's going to increase, they're going to be pushed off to the automated systems. And on the current automated systems, you can't pick up the phone and talk to a financial advisor when the market's crashing. You have to have an appointment, and that's why they can afford to charge so little money. So I look at this as almost like a looming crisis where, and you're talking about, cops and firemen with $400,000 in their pension who can't get a broker because it's the Goldmans and the Merrills of the world are going to put it down to 1/4 of 1%, or maybe for free, just so they have the money that they could use as leverage. So they're going to, these small investors, if there's a crisis or something's wrong, they're going to have no one to speak to. They're going to have no one to help them, no one to guide them, and they're going to act irrationally. And on a day when the market should go down 1,000 points, it's going to go down 3,000 points. So I was wondering about that.
No, that's no. I think that's fair. I don't mind. No. That's fair, man. Look, let me just capture the point. What's your name? John. So here's John's point, basically. Look, as it is right now, it's very difficult for an average American family who doesn't have $4 million to invest, but's got $400,000 to invest, to get good financial advice. Don't make it harder. I agree, man. Here's the question. What can I do to get them better financial advice so that they don't take that money into an office where they get sold something that they're not suitable for? And I believe that if we do this the right way, look, just saying you have to recommend the absolute perfect product for this person, I agree with you. People will exit the business, and that's bad. And by the way, even before I was at Bear Stearns, I was at a broker. I was at Smith Barney. Remember them? Smith Barney. What's that? Yeah, I used to work for a broker at Smith Barney. I got this job, and the guy I interned for. I used to dial for dollars, just like in the movie. I'd write down on the postcards, give it to him. The guy, when I got this job, emailed me. He said, "Congratulations. Don't come after me." Look, I think you're right about this. Here's I believe we can come up with a rule that gets a lot of the practices out of the market that don't belong there, with making sure that the people you're talking about can still get good financial advice. I believe we could do that. Let me just give one example of something I think is happening that I don't like, that really worries me. You guys know what levered ETFs are? All right, so the pitch here is, instead of getting the S&P 500, get 3 times the S&P 500. Okay, now I have seen data, John. suggesting that a lot of cops and firefighters and people who are 57 plus are in those products on a buy and hold basis. They shouldn't be, man. They shouldn't be. The reason they shouldn't be is that the way the products get you that leverage is they're rebalanced every day. And I can show you, I gave a statement on this not that long ago, I can show you in the math that even if you're right, the market goes up, you lose half your money just on the erosion alone on the rebalancing every day. So here's my concern, John. One of these cops you're talking about goes into an office, says, look, I've got 400, I'm short. I'm getting ready to retire, okay? 400 is not gonna make it. I don't need the S&P, I need 3 times. So he buys it. And lo and behold, it's a 9-year bull run. And the guy opens his envelope in 8 years. He turns to his wife and says, we're in great shape, and he looks at it, it's half the money. My view is we can and should say that's not appropriate for that guy. And that doesn't mean he can't get financial advice. But we can and should come out and say this is not a product he should be in. And I think that's the SEC's job. 100%? Just because you can't sell them a 3X? So look, here's what I'll say. You've had to do that on the law we have now. It's not because of regulation best interest or the fiduciary rule. What you're saying to me is be careful, pay attention to the cost of providing this advice. Because if his point is a very powerful one. See what he's saying. What he's saying is if those costs rise, it's not rich people are still going to get financial advice. Those aren't the people you hurt, he's saying. He's saying you hurt people who really need it. And I hear you. And I think everyone on the commission does, actually.
Hi, I'm Larry Carroll. I'm a string writer at Investors Business Daily. And I was curious, a lot of companies have tried to have Bitcoin ETFs, and the SEC keeps shooting them down. And I was wondering, what's the main reason that the SEC doesn't like Bitcoin ETFs?
Bitcoin ETFs. So I got in trouble about you can tell I get in a lot of trouble. Yeah. So we had a proposal from the Winklevoss brothers to do a Bitcoin ETF, and we rejected that proposal. One of my colleagues dissented and said, we should let 1,000 flowers bloom, and if investors don't like this product, then if they invest and lose money, them's the breaks. I thought that was a very easy case, and let me say why. The market we looked at in that particular ETF was the underlying asset was traded offshore in a very untransparent market with very thin volume. And we said in our decision, I thought this was right, that when you look at volume that thin, such that the price can be manipulated and pushed around by someone with not a lot of money, that's an investor protection problem that we're not prepared to let ordinary American investors get exposed to. And the thing to understand about ETFs, the benefit and the downside of ETFs is they are very easy to trade, right? That's the whole idea. Right? You don't even set up a separate Fidelity account, nothing like that, right? BD account, $7, you're in, you're out. That's what an ETF is. And I was very uncomfortable. Now, someone asked me once, how do you think about that? And I said, the way I think about it is, imagine my mom and dad, it's the Bronx, it's like 1979, they're taking that $20 and putting it in whatever. And would I have, that was the money that was going to eventually send me to college. Would I have wanted that in a Bitcoin ETF? And I said, hell no. And then apparently I said it again, hell no. And my mother, Robert, stop cursing. But I got to be honest with you, man. Like, do I really think that's a product that market is at a stage of maturity where we should be putting ordinary American investors in? I'm not convinced of that. Let me say something else, though. I'm willing to be convinced of it. So if you show me a transparent market that trades Bitcoin on a liquid basis, that is always sort of that's easy to oversee, where I understand the value of the asset, where it's like an equity or fixed income instrument, I'm not saying we should pick and choose the products people can invest in. That's not what we do. What we do is we make sure that they're not going to get manipulated against, that they're not going to get taken advantage of, and that the things they trade are going to be reflected in prices that actually reflect the value of the thing that they own. And that's what, in my view, that proposal didn't do. But if someone brings a proposal like that to us that does that, I believe we'll approve it.
Cool. Thanks. My name is Jonas Ekblom. I'm with Columbia Journalism School. This is more a down-to-earth question, but
I was looking at the 2020 budget appropriations, and you guys are counting with like a 30% increase in securities trading, but you guys are going to get only like a 5% budget increase. Do you think that like your agency is like increasingly underfunded, and like, you know, if so, like in what way does that affect you?
So the question is, are we underfunded? So again, I try to be as straightforward a guy as I can in these. You can tell I'm not long for politics. Are we underfunded? Yes. End of answer. Yes. We oversee trillions upon trillions of dollars in securities trading. The people that we oversee are some of the smartest, fastest, most strongly financially motivated people on earth. The idea that we should be able to do that with staff cuts makes no sense. I think our chairman has done a very admirable job in very difficult budget circumstances. I mean, a lot of agencies, CFTC, for example, have faced significant cuts at a time where they really do need as much support as they can get. Fundamentally, I'll tell you, we were shut down back in January. And without saying anything about the shutdown, here's what I'll say. It is fundamentally not a good thing that the SEC shuts down in this way. And you can ask any company that wanted to go public during that window, or anybody who faced an enforcement action, or anybody who was in our markets during that window. That was a bad thing. Destructive for the agency, bad for the markets. And here's what I'll say about it. It raises, in my mind, a real question about whether the SEC shouldn't be funded independently of the appropriations process and in the style of the Fed. I wouldn't be the first person to say that. I'm saying it's a question. I'm not the first person to raise it. But I can tell you, if you want to know my experience with it, what I saw was a market, by the way, that was in December, a very volatile place to be. And I saw 4,000 amazing public servants who wanted to engage in all the things we needed to do, but who couldn't come to work. And I saw that very up close and personal in a way that changed my mind about, I mean, the appropriations process has its benefits. I'm all for accountability, but I saw those costs up close, man. And it's got me thinking about whether we should be independently funded. Or the Fed, which is funded on an independent ongoing basis by fees. You know, and I can think of lots of models for this, and this is above my pay grade. And the budget request is really the chairman. And I have to say, I saw the article. There was an article that pointed to the increase in securities trading and the relatively small increase in our budget. I totally hear you guys. I think we have managed to do reasonably well if you compare us to other agencies in the government. And one reason that is, by the way, is that I think our value proposition has become clearer and clearer, especially with the chair we have now. I think he's done really well there. But if I'm being honest, do I think that the financial markets and their principal overseer should be subject to the whims of the appropriations process? I think that can be dangerous, and I saw that up close, man. So I'm wondering whether that's something we should be thinking about reforming.
I know we're very short on time here, and probably this has to be the very last question. So just very briefly, Laura Keller, former Bloomberg and board member here at Financial Writers. So maybe this touches on some of the themes that you've talked about tonight, which is a lot about retail investors. I feel like you've been kind of figuring out the gray zones, whether it's ICOs or the broker protocol. But one thing I haven't heard you talk much about is the sort of world of the more shrouded, the investor market, you know, where you have, whether you talk about securities that aren't securities, so loans, for example. What are you trying to do to kind of eliminate some of the gray areas in, say, hedge funds or private debt markets where you're not really seeing that retail investor behind, but there are other people who might be?
Yeah, it's a great question. I'll wrap up. Her question is, there are a lot of markets out there that aren't so retail centric, but still really matter to the markets. And I actually would say, just to push back a little on the premise of the question, fundamentally, if a pension fund gets hurt, a person gets hurt, right? If an institution gets hurt, whether it's a hedge fund, whatever, someone's the claimant to that money. I think about this a lot. And there are whole segments of the market that we don't oversee as a formal matter. And we ought to be thinking, we are thinking about the degree to which those markets are really working. Right? Let me give you an example of an area where I think we did really good work. So for years, you did distressed debt, but I don't know if there are private equity reporters here. But for years, private equity funds charged their portfolio companies a monitoring fee. You remember those monitoring fees? It's like we invested money and now we're going to watch it and charge you, the company. And those fees were very common in the market for like 10 years until our asset management unit not that long ago probed the degree to which they were disclosed and people really understood them. And we got better information out into the marketplace. Investors began to say, really? You're charging me to watch your money? No. And the market worked. And I think there's a lot of stuff like that we can and should be doing. And I would say I'm a guy who very much thinks that if you don't deter if you don't deter fraud in those markets, you're missing a big part of the story that really affects ordinary retail investors. It's very easy it's not very easy. These cases are really important, but when you have an obvious retail victim, to understand why you have to go after that case, it's a little harder to understand why it's really important to send a big message to the marketplace when an institution does something wrong. But to me, actually, that's the case for really hitting somebody hard. Because if you're a sophisticated institution and you know it's a gray area and you know what the right thing to do is and what the market expects and you don't get it right, that should be costly at the SEC. We should leave no doubt in your mind whether it was profitable to walk that line. And I've been a guy, I haven't said too much about this yet, but I plan to give a speech on it in the coming months. I'm a guy who is very much in favor of aggressive penalties. And this is why. Because my experience is people follow their incentives. And if you catch somebody stealing a little bit of the time and go light on them when you do, you make it profitable to steal. And again, I don't get mad at the guy for stealing. That's not his fault. He's got kids too, right? No, he's just doing what you're allowing him to do. To me, one thing we have to get better at is when we catch an institution doing something wrong, to make it hurt. To make them feel like, look, who knows if they'll get us this time, but if they do, man, it'll be painful. And I think, look, to the great credit of the people I work with now, they understand that. They want to make that clear. But every time we send any mixed message to the market about whether we're going to be serious about penalizing large institutions or gray areas of the market, I think we do investors a disservice.
There's a great book on that subject, The Chicken Shit Club, and one could write a book on many of the things we talked about tonight, but of course we don't have time for that tonight. So one last closing thought from you is, since you're in a room full of financial journalists in the world's financial capital, is there any one or two subjects that you think aren't being covered enough that financial journalists should be paying attention to and writing more of? What would that be?
So the question is, if I could get you guys to cover one thing.
You think isn't getting enough ink?
That's not getting enough ink. Tesla. No, just kidding.
Who was it that said Tesla? Tesla did come up.
Tesla's not the correct answer to that question. Doing it right. Dark pool trade. Interesting. I feel like that's gotten something. So, cybersecurity. And I say with all respect to the people in the room, to me, this is the thing we'll look back at 10 years from now and be like, why didn't we talk more about this? I go to every boardroom I talk to. These guys are concerned about it. Like, these are boards who are trying to do the right thing. And the thing you need to understand is that every single American public company is under attack for its data 24 hours a day, 7 days a week, 365 days a year. And if they lose, millions of Americans' data is lost in a way that will seriously hurt them in their day-to-day lives. And more importantly, will undermine their confidence in giving information about who they are and what they want to companies. Companies are trying to fight this every day, and there are state-sponsored actors. There are people who are trading on information based when they hack. And to me, how companies will be able to address this is like the defining challenge in the boardroom for the next 5 years. And the reason I think it's hard to write about is that when you write about it, typically what happens is someone gets hacked, and you write about the hack. And it's a lot less interesting to talk about what they could do to prevent it. or what as a nation we should be thinking about doing in order to deal with these problems. Let me say, I know we're over, but one more thing about this. Like, here's a thought to go home with. We have a bunch of very large companies that have lots of data on who we are. And those are the stories I understand. Those stories that make sense. But the way the data is used in the American economy, if a mid-sized company is hacked, that could hurt ordinary Americans just as much. Or a small company is hacked, they could have access to just as much important data. That's what's scary to me. Google, I'm sure, without speaking, a hypothetical company like Google, is on the cutting edge of protecting itself. I'm not so worried. I'm worried about the mid or small size company that's got people's social security numbers that could get hurt. And they are not going to be able to make the investment that Google can in protecting that information. And my question for all of you is, shouldn't we be thinking as like a marketplace about what we want to ask those companies to do to protect themselves? I think in a few years we'll look back and say, boy, we should have been more demanding about getting answers to those questions. Like, what are you doing about this? What are the investments? What are you worried about? What are the risks? We should be getting more disclosures about when companies get hacked and how that affects ordinary people. I've been a guy that's pushed very hard for that, and I hope the press will continue to dig into it because I think it's going to be very important.
And with that, we'll leave it there. Thank you so much for joining us. We really appreciate it. And ladies and gentlemen, yeah. With that, we're out of time. But ladies and gentlemen, the open bar remains open for business, so please continue to mingle and network, and see you at our next event. Thanks.